I hereby call this meeting to order. Good afternoon, everyone. I trust that you're all well and ready for our discussion today. We have a comprehensive agenda to cover, touching upon critical aspects of our economic landscape and monetary policy considerations. Our agenda encompasses the following key areas: a general outlook, and then specifically the labor market, financial markets, and residential market.
The general economic outlook is uncertain, with a contracting growth rate and conflicting indicators. Real GDP growth is sitting at 2.1%, with expectations of growth contracting roughly 100 basis points in the next 4 quarters. While this rate is similar to pre-pandemic levels, the volatility in post-pandemic growth rate creates hesitation in future expectations.
The data is pointing to a slower GDP growth in the next few quarters, but the investment sentiment is providing different signals for the current economy.
While decreasing investment sentiment showed the first signs of a contracting economy at the start of 2022, recent manufacturing and service sentiments are showing expansionary signs as expectations begin to increase. It's possible these could be the result of consumers' resilience in high inflation and high interest rate environments.
I agree. While service sentiment is showing expansionary levels, this is reflecting a shift in consumer preferences towards services during COVID, and consumers continue to pervade in high inflation. Moving to consumer resilience, specifically consumer consumption and economic growth have remained positive, demonstrating consumers' resilience through high inflation. Additionally, consumer saving rates continue to level out despite rate increases.
I agree. Consumer sentiment remains high at 69.5, and retail sales increasing from the previous month shows consumer resilience to inflation. However, this may be a driving factor in savings rates remaining low, as consumers' incomes may not be keeping up with inflation.
When we analyze the Consumer Price Index, the most notable factor is that core CPI remains high as energy prices continue to stay on average levels. A slight increase in CPI can also be seen, showing a modest uptick in inflation.
Considering this, consumers will experience a slight reduction in their purchasing power. These facts can influence inflation expectations, which may impact decisions and forecasts related to savings, investment, and long-term financial planning.
In addition, a core CPI that is consistently above 4% signals a period of high inflation and increasing costs of living.
Consumers may experience a significant erosion to purchasing power as well.
I agree. Therefore, it is crucial to monitor these trends, as this may result in a reduction of the real value of savings and fixed income investments, thus affecting long-term financial planning. Inflation remains a significant factor impacting our policies, as both core and overall PCE percentages are above typical target levels for stable prices. Looking at the core percentages, especially with increasing energy price volatility, it is fortunately coming down.
This does depict a slight slowdown in consumer spending, but our goal should be deriving a balance between encouraging economic growth on one hand and controlling for inflation on the other hand.
In evaluating the labor market, the past few years have presented American laborers with several unprecedented challenges regarding their employment, and the data on this remains rather conflicting. Overall, U3 unemployment remains similar, if not slightly elevated, to pre-pandemic levels at 3.8%, although forecasts suggest minor increases over the next few quarters. Likewise, the gap in unemployment between men and women remains elevated relative to the pandemic era. Indeed, such evaluation may reflect inconsistencies in the data.
Month-to-month from August job openings increased by an astounding 7.7%, an unexpected result given the recent decline in employers hiring new workers and current workers quitting. It's possible this may reflect some level of structural inefficiencies in the labor market, possibly reflecting a misalignment in skills between these jobs openings and the skills of unemployed workers.
It is possible that a significant level of the labor force is still exploring lifestyle changes as a consequence of the pandemic. Those changes could reflect this misalignment in the labor market.
Now let's turn our attention to the financial markets and their condition. In financial markets, we see continued signs of tightening. While there is limited stress at the moment, some indicators are pointing towards future stress. Turning to the interest rate environment, we see an unusually high interest rate environment that continues to rise. The federal funds rate is at 5.33%, while the 2-year Treasury yield is currently rising at a level of 5.04%. And the 10-year Treasury is yielding 4.59%. These numbers came in as of September 1st.
Interesting point. As rates continue to rise, we can expect to see further tightening in financial markets.
Well said. Now, moving on to the yield curve. The yield curve remains inverted as measured by the 10-year Treasury yield minus the 2-year Treasury yield. A yield curve inversion tends to be a leading indicator of recessions. What's interesting is that the current inversion has been unusually steep and unusually long, which could suggest heightened stress coming in the next few months.
Yes, I did notice the current level of inversion is 0.44% and trending upward as the 10-year Treasury has been gaining.
The interest rate environment has caused some deposit flight, and banks' reserve balances have fallen over the past year. These signs indicate the credit conditions could remain tighter for longer as banks have a smaller deposit base to lend with.
That is true. It is possible that banks' deposit rates are continuing to lag behind the broader interest rate level. And so as general market rates rise faster than deposit rates, we could see continued deposit flight away from banks. Now moving on to general credit conditions. This data from the Senior Loan Officer Survey points toward tighter credit conditions for a longer period of time. A net 50% of banks are now tightening their standards in commercial lending, which corroborates the interest rate data that we could see tighter for longer conditions.
Levels of past due loans remain at historically low levels and are trending downward, which signals a healthy financial system. However, banks have been increasing the provisions for loan losses as recent periods would suggest some expectations of stress are on the horizon.
While this is true, that the level of past due loans is relatively low, the increase in provisions for loan losses by banks could indicate a cautious approach rather than signaling imminent stress. Banks are proactively preparing for potential economic fluctuations and reflecting prudent risk management practices. Further global economic trends and geopolitical events can influence bank provisions for loan and lease losses. Therefore, the recent increase could be a response to these external factors, not necessarily an expectation of stress.
I see your points. However, we should still consider future loan defaults resulting in keeping rates as high as they are.
Finally, looking into the current state of the commercial and residential property markets, we find a post-pandemic slowdown in the purchasing and development of new properties. Housing inventory remains high, indicating a slowdown in the residential market and overall economy. Additionally, new housing startups continue to remain low, further demonstrating a slowdown in demand for new housing.
Well, that's interesting. While it's true that housing inventory is relatively high, this can often be attributed to seasonal and regional variations rather than a broader indication of a slowdown. Seasonal fluctuations and localized market dynamics can influence inventory levels without necessarily signifying a slowdown in the overall residential market.
While I agree, I believe that high inventory is the direct result of high rates and housing prices rather than the usual seasonal effects.
Yes, I do see your point.
In light of a shift to remote work during COVID, office vacancy rates have hit historically highs, currently at 13.1%, with the highest rates seen in tech hubs such as San Francisco and Silicon Valley. This is putting major stress on commercial mortgages and should be monitored closely.
Having reviewed these latest economic data, we now must come to a decision on our policy going forward. We must continue to reduce the size of our balance sheet to pre-pandemic levels. Selling securities at a rate of 100 billion per month will maintain a trend of balance sheet normalization. This will put continued pressure on long-term interest rates, but this measure is necessary to bring the money supply down to a relatively normal level.
Considering our overall overview and assessments of the key aggregate factors, and given previously aggressive rate hikes, I would suggest we hold rates around 5.25 and 5.5% and continue hawkish undertones. However, I would also recommend caution in watching economic data as we seek a soft landing to our 2% inflation target, as this meeting has demonstrated the prevalence of mixed signals in the data.
All in favor of holding the rate, say aye. Aye.
Aye.
Nay, decreasing demand deposits are putting stress on the banks, and without considering potential lags, the current aggressive rates could have severe consequences. Therefore, I believe a 25 basis point cut would be the optimal next step.
Nay, I disagree. Given the persistent inflation numbers, the relative strength of the economy, and our previous forward guidance, I actually think a 25 basis point increase could be appropriate.
Well, the ayes have it, and we will maintain the current rate. I now adjourn this meeting.